Good afternoon, and welcome to today's conference call on the expectations for prudent commercial real estate loan accommodations and workouts. My name is Bill Garber. I'm the Director of Government and External Relations for the Appraisal Institute. Thank you for joining us today. We will be discussing today a recently issued policy statement by the federal financial institution regulatory agencies on commercial real estate loan accommodations and workouts. The focus of today's call will be to discuss the highlights and points of emphasis by financial regulators within the new policy statement, in particular on the issues of loan accommodations and commercial real estate loan workouts. Before we begin today with our panel, just a couple of logistical items. We are intending to run for 60 minutes. There will be a Q&A session involving the attendees and participants at the end of today's session. You can ask a question by clicking on the Questions tab and submitting it through the chat feature. And one disclaimer, the opinions and views expressed on today's conference call are not necessarily the views and official positions of the organizations or the host entities involved. So I'd like to introduce our panelists today. With us is Carmen Hawley, the Senior Supervisory Financial Analyst with the Federal Reserve Board. Melanie Seeger, Senior Vice President and Appraisal Manager with PacWest Bank and Chair of the Appraisal Institute's Client Advisory Board. And Justin Slack, Chief Appraiser and Environmental Risk Manager for Washington Federal Bank and Chair of the Government Relations Committee of the Appraisal Institute. So today's topic is the recently issued policy statement from the federal financial regulatory agencies. We've asked Carmen Hawley with the Federal Reserve to come and brief us and discuss the major points of emphasis within that statement. And so we'd like to invite Carmen to give an overview, and then we'll be turning to our panel for further discussion and questions. So Carmen, I've got your slides pulled up, and welcome to today's call.
Okay, great. Thank you for having me today. Thank you, Bill. And I'm really excited to be here to talk about our recently issued guidance. I'm going to start on slide 2. This is the Federal Reserve disclaimer that I have to read. I know, Bill, you just read one, but I'll just read the board. Because I have to do that. It's a little bit of housekeeping. The opinions expressed in the presentation are statements of the speaker's opinion, are intended only for informational purposes and are not formal opinions of nor binding on the Board of Governors of the Federal Reserve System. So now that we have that done, I'm moving then to slide 3. So the agencies issued this guidance back in June, and today I wanted to take a few minutes to highlight, before we go into questions, I wanted to highlight a few slides that will give you an idea of some of the more important sections of the guidance. So the 2023 guidance updates prior guidance that we had issued in 2009 when commercial real estate was greatly affected by the financial crisis that was going on at that time. This slide explains what's new in this version of the guidance. So the revised guidance adds short-term loan accommodations to the risk management framework for problem CRE loans. It updates the accounting treatment for these loans, updates and expands the section containing examples or which are really case studies of problem CRE loans. And then we also modernize the language throughout the guidance. Even though the guidance was revised, The risk management framework that was outlined continues to encourage banks to work with their borrowers through times of financial strength. And the way the guidance is laid out, there are some key messages, and then there's a discussion about the risk management framework. So I'm just going to kind of go through it in those two sections. Moving on then to slide 4. So there are some key messages that were in the 2009 guidance that were retained in the 2023 revised guidance. So I listed them on this slide exactly as they appear in the guidance because I think it's important for you to see the exact wording. So the first bullet emphasizes that banks won't be criticized for engaging in loan accommodations or workouts. The second bullet states that loans to borrowers who continue to have the ability to repay won't be classified by the examiner, and that means rated substandard, doubtful, or loss, solely because the value of the property has declined below the loan balance. So these are the two headline, I call them headline key messages that are in the guidance. They were in the 2009 version, and they were carried over to this current revision. Moving on then to slide 5. There are some other important messages that are also meant to encourage banks to work with borrowers whose property values may have declined, but they're still able to make the payments and they remain creditworthy. So I'll just take a minute to read through these because I think they're important, and it's worth the time just to go through them. The guidance encourages banks to work constructively with creditworthy borrowers. It confirms that prudent loan accommodations and workouts are in the best interest of the financial institution and the borrower. In the guidance, we promote supervisory consistency among examiners and enhanced transparency of CRE loan accommodation and workout arrangements. And then we also support supervisory policies and actions that do not inadvertently curtail the availability of credit to sound borrowers. So then moving on to slide 6. In regards to the sections in the guidance that are about risk management, loan accommodations are the concept that is really new to this document. So I thought it would be worthwhile outlining in a slide what are the differences between an accommodation and a loan workout. So if you recall, or if you're aware, during the COVID crisis, the agencies issued guidance on short-term loan accommodations. And in that guidance, we define them and we encourage their use. So we took that guidance and carried it over pretty much verbatim in many parts over to the 2023 revised CRE guidance. So if you were familiar with that old guidance, you'll see a lot of it looks familiar in that section of this 2023 CRE revision. We see accommodations as another tool that banks are encouraged to use when working with borrowers during times of financial stress, with the overall goal of providing relief to the borrowers so they can recover. Accommodations are generally short-term in nature and are taken prior to moving to longer-term workout arrangements. Some examples I can give you of short-term accommodations are if you allow partial payments, do some type of payment deferrals, perhaps initiate forbearance activities, minor modifications, or some type of short-term extensions, all would be examples of short-term accommodations. Loan workout arrangements, which you're probably most familiar with, on the other hand, are longer term arrangements. They're more formal. They can involve restructuring of the loan. There may or may not be concessions. It would involve a longer term renewal or some type of long term extension. So then moving on to slide 7. I wanted to summarize the section in the guidance for this audience because there is a section that contains a discussion of how examiners will assess collateral values. So examiners will assess all valuations, and that includes appraisals, evaluations, and evaluations, whether they're done externally or internally, and any updates that have been done to those. And they're also going to look at reviews that are done of valuations, because as you're aware, banks are required to review appraisals and evaluations by regulation. When looking at these valuations, examiners are going to assess the major facts, assumptions, and approaches that were used by the appraisers. Examiners are also going to consider the impact of current market conditions. Also, by regulation, banks are required to monitor real estate market conditions in their lending area, and that's in our real estate lending regulation. Examiners are going to consider market conditions when they look at the valuation and the impact of any changes in those conditions on the value. And then examiners are going to look at the institution's valuation process overall, which is kind of what they do. At all loans, when they're looking at all loans. So then I'm moving on to slide 8. Okay, after examiners have assessed the valuation, if they see weaknesses in the valuation or in the bank's review process, examiners can direct the bank to obtain a new valuation. That means an appraisal or an evaluation. If the bank is unwilling to, or more likely unable to obtain a new valuation, and there could be a lot of reasons behind that, it could be a timing issue, etc., examiners will need to do their own analysis for the purposes of classification, and that would mean deciding whether or not to assign a regulatory rating and which one it should be, and that those regulatory ratings are substandard, doubtful, or lost. So examiners will do their analysis for the purposes of classification, and they will adjust the values if needed when they can establish that there are underlying facts or assumptions in the existing valuation that are no longer appropriate, or the examiners can support alternative assumptions based on available information. So I wanted to also emphasize that examiners are not reappraising the property. We got questions about this during the comment period when the guidance was out for comment about examiners changing values and why are they doing that, and they're doing their own appraisals. That's really not what they are doing. They are adjusting values for the purpose of classification. If the examiner feels like the existing valuation is no longer valid or applicable because conditions have changed, the first thing they're going to do is direct the bank to obtain a new valuation. So, that's their first stop. And as I mentioned, if for some reason there's not time to do that or whatnot, then they'll go to step 2, which is to use the information that they have to adjust the value. So then moving on to slide 9. Wanted to talk a bit about monitoring collateral values. Examiners are going to look at the bank's procedures for ongoing monitoring of real estate collateral. So knowing that, I wanted to discuss best practices that are in the guidance for banks to monitor collateral values. Banks should consider current project information and market conditions and any changes that those could bring to the value, or any information that they've gotten from a new appraisal or an evaluation. And as we talked about, banks are required by regulation to monitor the market conditions in their lending area. So the guidance gives a list of examples of changes to look for, and these changes might trigger the need for a new valuation. And I took that list and put it on this slide, so you can see the bullets here. I thought it would be good for you to see them because they're a good starting point to use when you're considering monitoring the performance of the property and considering whether or not the new valuation is going to be necessary. Also, to be considered are the regulatory requirements for when a new valuation is needed, and that would be the normal requirements that are in the appraisal regulation. And then also the bank's internal policy. There may be instances where a bank's policy requirements exceed the regulatory requirements for when a valuation is needed. Moving on then to slide 10, more about monitoring collateral values. So once, the banks have gone through that exercise, what are the possible outcomes of that analysis? And one possible outcome would be there's a decision to get a new appraisal. Certainly with the advancement of new money and a change in market conditions, according to existing guidance, a new appraisal would be required in that instance. Under certain circumstances, all that may be needed is a new evaluation. For example, if no new money is advanced, okay, that might be an instance where an evaluation is all that is required. There may be other facts and circumstances that would require something more than an evaluation, but there are possibilities that an evaluation is all that would be needed. Also consider collateral dependency and the need to determine fair value of a piece of real estate. If a loan becomes collateral dependent, if you've got to do the accounting fair value exercise, that also could be a trigger for an updated valuation. Okay, and moving on to the next slide, which is slide 11. I wanted to call your attention to the appendices in the guidance because there's just a ton of useful information in those appendices, and this is one of the few pieces of guidance that I know that has such a robust set of appendices. And for example, Appendix 1 in the guidance has, these extensive case studies. These are illustrations of how the guidance should be applied to various property types. And also in those examples and case studies, there are also illustrations of when updated valuations are required. In this version of the guidance, we added 3 new property types to those examples. We added a hotel example, residential ADC, and a multifamily example. We also made some changes or updated the examples to delete TDR reporting because, as you might be aware, the FASB discontinued or no longer requires TDR reporting for most institutions as of, I think, the beginning of this year. So we deleted that from the examples in the guidance. So along those same lines, on the last slide that I have, which is slide 12, I gave you a list of the appendices because like I said, there's great information in them. Appendix 1 we talked about with the examples. Appendix 2 has a list of complementary guidance and regulations for reference that you can use, and these are all about real estate or appraisals. Appendix 3 discusses valuation concepts. That was in the 2009 and there weren't really many changes there, but it continues to be useful. Appendix 4 has the definitions of the adverse classifications and special mention. And then Appendix 5 was updated for accounting treatment for these loans and how the new CECL methodology should be applied. So that's all that I have, Bill, as far as slides are concerned to kind of explain the highlights of the guidance. So I hope that was helpful. And I guess I'm ready to answer any questions, or I hope to be able to answer any questions that the audience has about the guidance.
So much, Carmen. That was a great tee up for us and our panel, and we'll turn to them next. Melanie Seeger and Justin Slack, welcome to the call, and appreciate you spending time and discussing the new guidance from the regulators. Let me just first, in your respective positions, ask what's your initial reaction to the new guidance? What really stands out to you as you've initially reviewed the statement?
First, whatever I say is my own opinion and not the opinion of Pacific Western Bank. What stood out to me, I think it was also in the prior guidance, but just that even the LTV could rise even above 100%, and it's still, possible to do a loan workout, and it's encouraged in this environment, and that appraisers should be aware of that because, it's fine if the value dropped, and then there's also the question of if the same appraiser appraises the property at origination and then the market turns and then the value is suddenly maybe 30% less, then that's just the way it is. And sometimes it's better. I wanted to hear Carmen maybe later about her opinion. If a bank should order a fresh set of eyes, as we call it, so an appraiser from a new appraiser, but that we are in an environment of declining values at times here, so that stuck out to me, that the LTV oftentimes can quickly go above 100%, but it can still be worked out, and that the loan notes, sometimes the loan can be divvied up into loan note A and B, where loan note A is the one that's still performing and the LTV is within supervisory limits, and then loan note B is the one that's subpar and that's being treated differently in the accounting by a bank. I think that's something to be aware of. And I think that's all for now. Turn it over to Justin.
Before you go into that, Justin, since you raised that issue, Up front, Carmen, do you want to talk to the fresh set of eyes question?
I mean, there's no requirement for that. I think that's a decision that the bank would have to make. Certainly, it's competency, right? That
Mhm.
banks should be thinking of when they decide whether to engage an appraiser for an assignment.
Mhm.
So, I there could be a lot of reasons for the decline in value, and I would say that the bank would have to make that decision. There's nothing in regulation that would
Mhm.
state that.
Okay.
Carmen, Justin, what was your reaction? What are your key takeaways?
Yeah, thanks, Bill, and thanks, Melanie and Carmen too. One of the things I saw here was I like it for appraisers as a playbook, right? This is if you do any bank work for any work, for lenders or regulated institutions, you can see what they are working or what this is what they have to work within or what the examiners are looking at. So some of the things that I kind of jotted down when I first read it was the importance of the intended use. A lot of times appraisers will get assignments and maybe there's limited information or no information. And really, I would say to the appraisers is go back to your client then and ask him, hey, what is this intended use? Is it really loan underwriting? Is it loan monitoring? Um, because you can see here, there's a lot of options that banks have. And so if a bank calls you and says, hey, I got this deal and I need to, you know, the market conditions changed or the income has dropped. I'd like just maybe a limited scope appraisal, right? Maybe because it's for the states that for the appraisers that can't do evaluations yet, they can do a a limited scope or restricted appraisal that meets the interagency guidelines for an evaluation. Maybe it's just the income approach, and some people might say, "Oh, I'm not touching that because I have to do a full self-contained." Well, this is saying, I mean, there's certain circumstances where maybe you don't have to. So I think getting down to the, asking the question or requiring your client to really don't be afraid to ask them, what is this intended use and what are you guys actually doing with it? Don't be afraid to ask because I mean, I'm on our deals on the front end, we're going to be, if we get these things, we try to be full disclosure up front, everything that we know, just so the appraiser knows when they're bidding it or when they see what we're trying to ask, and they'll understand that we're not trying to pull a fast one on them or anything. So I just think I like the examples, the ones that they added as well. Obviously, the AD&C stuff that was from the last downturn, the stuff that we're seeing now, we've come out of that for the residential construction. But again, several examples of situations that banks might be in, and even for bank appraiser or internal folks that maybe they work under credit. These are things that they can go back to their credit team and work with them and say, how should we build some of our stuff up? How can we do this? How can we be better and get better valuations for the bank? So I see both sides of it, or I see benefits on both sides.
Yeah,
Carmen,
and
I know that, go ahead, I'm sorry.
No, I was going to just interject there is that what we're stressing as far as the examples are concerned, what we're stressing to the examiners is that, they are just illustrations because we don't want, folks thinking that those examples are, hard and fast or very prescriptive. And, if you have X, you have Y. We really are trying to stress internally, at least here at the board, that these are illustrations, but you have to consider the individual facts and circumstances of the credit extension. But, it's a good starting place just to get an overall understanding of how different situations and property types should be treated.
Thanks
Hey,
for that,
Bill,
Carmen.
one more thing too. I was going to say, when you read this, you can see the importance of what the examiners are looking at is the importance of market conditions, right? I mean, so many times we'll see something that might be, you know, stale or dated or from 3 quarters ago. Obviously, when if somebody calls and says, hey, we have a loan monitoring situation, we need to get this updated because of X, Y, or Z. For appraisers, you can really help your client out, you know, your bank client out by giving them the most up-to-date market conditions they have, obviously, because that's what they're getting asked for by the examiners, right? Or if that's what they're supposed to do. So the importance of that, I can see it. I felt like it was stressed in here, and it's not cliche. Obviously, we always want current market conditions, but obviously in scenarios, if we get to these types of situations, it's
Right.
really important.
Exactly. Well said.
And I think this was one of the first sessions that you've done on the new guidance. What does the agencies have planned going forward to get information and education out on the street and in the banking community on the new guidance and their perspectives?
Well, we are making some plans currently. We don't have a date yet, but for doing an Ask the Regulators session. You know, some may be aware that the Federal Reserve has the Ask the Fed platform, which we frequently use as a venue to explain new pieces of guidance. It's a webinar format similar to what we have, what we're doing today. So we are going to engage the other agencies, OCC, FDIC, and NCUA, to join us in that platform, and we're calling it Ask the Regulators. We've done this before. People may be familiar with it, but that is going to be upcoming on this guidance. And then we're also doing similar internal training for our own examiners. I know we are here at the Fed. You know, because we have new people in the exam staff that weren't around in 2009 that might need a refresher on a lot of the concepts that are in this guidance. So, you know, it's not only an industry education exercise, but we're also going to be training our internal staff as well.
Thank you, Carmen. For Justin and Melanie, any other burning questions that you have for Carmen while we have her from a broad industry perspective?
It sounds like most of the time an independent valuer other than a staff member of the bank should do the eval and appraisal. Is that correct?
Well, appraisal, you know, the requirement is, you know, certified and licensed. Mm-hmm. Most often for banks, that does involve a fee appraiser. Evaluations, however, don't have that same requirement. I know it depends, again, on the institution of whether they want to allow their internal staff to do evaluations or not. Mm-hmm. It's not required by regulation, but that's you know, something else that would be in the bank's policy. You know, what they want, how they want to handle evaluations.
So it could very well be that portfolio manager does the analysis / eval, and then the review staff reviews them.
Well, I would say, number one, they should have, you know, some background and experience and mm-hmm. knowledge, overall knowledge, right, of mm-hmm. valuing property. And that varies, right, depending on person to person, requirements for the institution, and everything else. Mm-hmm. And, you know, this is all discussed in the interagency guidance, right? We have a whole section on evaluations and who can prepare them and what their background should be. Mm-hmm. Evaluations do have to be reviewed. We put that in regulation, so both appraisals and evaluations should be reviewed.
Mm-hmm. Yeah, of course.
By separate party. Yeah.
Justin, did you have any questions?
No, I'm good for right now.
So a question for the panel generally. we've talked a little bit about the appraisal and evaluation issue, and there's nothing changed as far as the requirements for appraisals or evaluations with the issuance of this new guidance. I want to emphasize that. But I'm curious as to whether there are opportunities that we might think about for appraisers to develop or build out a line of practice that might answer some of the questions that are being asked here. And specifically, we've talked about the concept of validations before, where there's a relational value construct, and it's at least X or Y amount type of question. Is there is the prospect or the need for a validation like service, has that changed at all here with the issuance of this guidance, or has it stayed the same? What's the overall kind of makeup of the landscape around the validation prospect?
Is that for me, Bill? Or
I was asking the panel, so whoever wants to step forward into that.
Well, I'll go first.
Yes.
First, Carmen, just to give a view, and then certainly would welcome to hear what my fellow panel members, how they feel about it. When you're talking about this guidance and problem commercial real estate loans, I would be careful with validations, right? Because usually in these situations, things are changing. Market conditions are changing. Things are changing with property performance. So, that whole issue of validating the existing appraisal comes into question whether, that's really going to be enough versus, a new appraisal, or at the very least an evaluation where you're bringing into consideration the changes that you're seeing and that we've talked about. So that's just my view about validations in regards to problem loans. Outside of that group, certainly validations are something that we've talked about and we've encouraged the use of before.
Yeah, maybe not in the context of changing and deteriorating market conditions. I think when market conditions improve, then validations are great. It's relatively, very applicable. It's at least worth X, so it's fine. Everything is rosy, but now everything is declining. So what are you gonna say? It's at least, I don't know, 30% lower. I don't know. Yeah, I think it makes more sense in an improving market in general. That's just what I see right now. Comes to mind.
And I'd say I agree. Under the loan workout program section in here too, obviously the very first thing, it says loan workout arrangements can take many forms, including but not limited to. And the first thing is renewing or extending loan terms. So obviously if it's at that level, that's probably like, maybe there's nothing with the collateral, but maybe with the borrower, maybe that's an option that you do a validation. But if it is deteriorating market conditions, if the collateral is deteriorating for whatever reason, then to what both Carmen and Melanie said is you probably need something new. Validations work great when things are not even rosy, but if they're just steady Eddie, right? If they're just hang out for the last 3, 5, 10 years, been no changes, not a big deal. But if there are changes, that's obviously where I think they want you to get something new. And Bill, to your first part of that question is there something that appraisers can do? I think this shows that there are several different things that are needed, and appraisers, how they choose to do that, if that's in their book of business or not, they can, if it's not, they might be able to expand it to say, again, I don't, if a client calls and says, I need something maybe like a limited scope, or I have an income producing property, I need the income reanalyzed, or give me a new income approach. It's not, again, that maybe we need something. Is it that we want less? In this circumstance, we're trying to tailor it to exactly what the problem is. And I think having the conversation with your client for the appraisers is paramount in these instances to say, what is it you guys are doing? What are you trying to do? What are you trying to accomplish? And then maybe there's something that can be worked out. Maybe there can't be either. Or I talked to an appraiser yesterday, or let's see, yesterday or Friday, and they said, I can't do that. I said, well, you can do that if maybe you don't want to, and that's different, and that's fine. But it's not something that you can't do. And you have to have, familiarity with your clients, and you have to have a comfort level. There's probably some clients out there that are just saying, hey, Melanie, can you just, slap this together for me? It's not a big deal. And you're like, whoa, wait a second. I don't know if I trust that Justin guy. I want to make sure. So, having those conversations again, I think is really important right now.
And also, an appraisal is always a point estimate of value. And what I'm seeing in the guidance is the examiners are looking for the trend as well, or they themselves are looking. I mean, there's always only a point estimate, but in a year the value could even be lower. So the appraiser maybe should keep that in mind to include more market information as to, is the market declining still? Of course, not give a point estimate in the future, but see the velocity of the deterioration, maybe, if you can call it like that. Keep that in mind, that market conditions are dynamic and changing. And where is it in the cycle? Maybe give some more information about that.
No, I would definitely agree. I would definitely agree that trends are important, and trends are something that examiners are going to be looking for as well, because remember, they've got to make the decision of whether or not to classify the loan. So they're certainly going to be looking at trends. And, part of what this guidance says is that loan to value is going to, not be the driving force for the classification, or not be the sole source for the classification, as long as the borrower can continue to pay. So, certainly, performance trends overall are going to be something that examiners are looking at, to confirm that ability to pay is still there.
Yeah.
Do we see a need at some point for a two-value construct potential for market value and liquidation value requests as a result of either this guidance or the current conditions in the marketplace?
Well, I saw on here some of the examples that said too, depending on how the bank is going to handle it, or how it is structured or classified, is if it's the your prospective market value upon, say, stabilization, or if it's going into REO, you're going to obviously have the as-is value, and it gives guidance to institutions on how to which one of those to use. I'll probably defer to Carmen on liquidation value. That's typically I would say institution by institution specific and how they want to handle that.
The market value is always what's needed as far as regulations are concerned, right? So even if the bank would request different or additional values, market value is always what should be used to determine the loan to value. So, the accounting considerations when you get to, you know, if you have a problem loan, and as I mentioned in the presentation, collateral dependency comes into play, then, you know, you've got to do that fair value calculation. And a lot of that, you know, fair value and market value a lot of times run the same, but you would still have to get a market value to calculate the LTV for regulatory purposes.
Thank you, Carmen. And for our audience, remember, you can ask questions in the questions tab. We have about 13 minutes left on the program. We've received a couple of questions. One was just related to the slides, Carmen, and whether they might be able to obtain a copy of them, the PDF version of those. I did post that we would be making the recording available on the YouTube page, but maybe you could address whether we might be able to share the slides.
Yeah, I can confirm that with you after the call, but I sent you a copy of them, Bill. I don't see a reason why we can't arrange to do that.
Thank you very much. And then to get an actual copy and review the new guidance, I could post it here. Well, I could even attach it, but I would have to pull away from my moderator screen, which wouldn't be the best thing to do in the middle of this. Where would be the best place to locate it? I mean, the actual title of it is Prudent Commercial Real Estate Loan Accommodations and Workouts. I think it's easily Googled, but is there a more direct way to obtain it, Carmen?
Yeah, you can on the board's public website, www.federalreserve.gov. There's a tab, there's a Supervision and Regulations tab, and you can pull up any of our guidance documents. You can go by year, put in 2023, and it should pop up. It's our SR letter 23-5. So you can search by that, or just going under that Supervision and Regulation letters. It's the Supervision and Regulation tab. Then you'll see Supervision and Regulation letters, and then you can click by year, and it'll pop up. And you can access any of our guidance documents that way, so it's really easy to get to it. I had one thing I wanted to interject, Bill, but I don't know if you have another question. You can go with the question, or
please interject, because the questions are coming in slowly. We did get confirmation of the link and the document, so thank you for that.
Yeah. One thing I wanted to say was, as an appraiser reading this guidance, what I would focus in on are, and what I tried to bring out in the presentation, is this guidance tells you what examiners are looking for. So, you know, a lot of the guidance that we write, it's about banks and, you know, do this, do that, and this is what our expectations are. But throughout this guidance, we actually say what examiners are going to be doing and what examiners should be doing and what they're looking for. So I think that's what makes this guidance a little bit different. And certainly there's a whole section on valuations in the guidance that would be of interest to appraisers. Supervisory assessment of collateral values, which tells you how appraisers are going to look at those valuations. I touched on that in the slides. And then also, as I mentioned, those examples, I know they're long and some of them, you know, go into a lot of detail, but, you know, they are good illustrations, and a number of them, if not most of them, do talk about the valuation decision. So you'll get an idea of what's in the minds, or what should be in the minds of the examiners as they, when they're looking at these problem and deteriorating loans.
Thank you for that.
Bill,
Okay,
one other one other thing
Please,
that I wanted to
Justin.
bring up that is here, it's also obviously in the interagency guidelines, but all the examples in here talk about the perspective, you know, the prospective value. So either the as-is market value obviously is necessary, but then a perspective upon completion or a perspective upon stabilization. They don't talk about a hypothetical as if complete or as if stabilized. Obviously, my conversations with the examiners over the years, it's, you know, they want to make sure that institutions know what the property is going to be like when it comes online or at this future date. So again, if you're an appraiser and you see somebody ask you for an as-is market value and then a hypothetical as if complete today, don't be afraid to ask them, hey, I don't see that. I don't see a definition anywhere in interagency guidelines. I don't see it in this policy statement on prudent CRE loan accommodations and workouts. Do you need that? They do need it. We do need that. But again, a lot of times we'll ask for it in our engagement letter, but we'll see appraisers only give us like the hypothetical, and I'll have to go back and I'll say, I'm sorry, you know, we can't just use that. Like you can use that for prudent underwriting or safety and soundness, but under interagency guidelines, we need this. So again, when you, like Carmen said, this is what examiners are going to be asking the banks. This is the bank's playbook of how they might handle some of these situations. So, you know, look at that and use that, you know, as a guide to help you with your client. Maybe you know, having those conversations with your clients too might, again, there's plenty of banks out there that don't have appraisal departments, that they need our help as appraisers. And if you understand what they also need, it'll be a win-win.
That's a very good point, Justin. Thank you.
More communication, better understanding of the premise.
Yeah, don't be afraid to ask. I would agree. Something is unclear. Sometimes maybe it's even good to have, you know, at loan origination, I don't know how Carmen sees that, but I do think it's okay to have a kickoff call, you know, with the appraiser department and somebody familiar with the deal. So why not do that when the asset is deteriorating? I think that could be a good strategy too, and then everyone is on the same page.
We have a participant that agrees as well. He said that makes sense, Justin. As a perspective upon stabilization value should reflect current market conditions as it relates to absorption.
Mm-hmm. Carmen, does it make sense to get a value, let's say, if you want to do a loan workout to extend the loan by 12 months, let's say, to get a prospective value as well, even though there's no specific like lease up going on, but the value might still be declining. So would that be of interest, or is that something it's too muddy right now to do that?
I mean, I don't see a problem with it. Certainly the as is would be needed, right? But, you know, having, you know, a perspective or as completed value could, you know, provide, you know, some type of I don't want to call it a benchmark, but some type of guidance, you know, an indication of where things might be going. But, you know, the as-is world is, you know, probably what's going to drive ratings.
Okay, yeah.
And a lot of times too, we will ask for those several scenarios from the appraisal side. So we'll have that, then let the credit folks, you know, I always say, you know, dealer's choice. You pick you know, what's going to work best for you guys. We'll order it for you and get it teed up, and then you guys, you know, work your magic on your side, and you can, but at least they have those. And again, I've talked to appraisers and they say, man, it's tough because every client I have, you know, I work with has different requirements or wants different value scenarios. And I agree, like they probably do. But again, don't be afraid to ask, why are we doing this? Or because, you know, Melanie and I might have the same ones, but, you know, Bill and Carmen might have different ones. And that's not that it's wrong or that we're right and they're wrong, or vice versa. It just means, again, based on our institutions, what we want or how we're doing it. And so I expect to see a lot of people asking for different scenarios, and a lot of that's it's institutional specific based on what they're trying to do.
Mhm.
We're getting close to the top of the hour. Let me turn to Justin and Melanie for any final thoughts.
No, I just like what I said, communication is key. Melanie said having those kickoff meetings, I think is good on the inside. If you can get your, we've been away from this for a little while, so having the portfolio managers want to call you and talk to you, they probably, if they weren't part of the group the last time around, they probably don't know that, and so you have to probably build that up internally. And then again, for the appraiser side, I think there are opportunities here for various assignment types that maybe aren't just a full meal deal, but some variations and flavors.
Yeah, communication is key. I agree. It's always good to get on the same page, yeah, with all the valuation scenarios and why we need it. So, yeah. Thank you.
And another thing, yeah, one thing I wanted to interject, Bill, is that, this guidance shouldn't be perceived as, because, one of the key messages in the guidance is that, we won't classify loans if the value has dropped. You should not perceive that meaning that you don't need to do an appraisal or an evaluation or update your valuation. It's still certainly important to, as I have talked about, stay on top of what the current value is, especially in a deteriorating situation. So, even though the guidance encourages working with borrowers, gives banks more of the ability to do that, we continue to think having a current, sensible and up-to-date, according to current market conditions, valuations is extremely important in these situations. And we encourage that in the guidance, along with, the work with your borrowers message. So I just wanted to make sure that no one was out there thinking that, the agencies don't think it's important for you to to update valuations because they're not going to classify the loans anyway. Do you know what I mean? That's really not what this is about.
Yeah.
It's really about both things. Understanding where you are currently and then being able to work with your borrowers.
Carmen, that's a perfect last word. Thank you very much. So we are at the top of the hour. I want to be respectful of time. I would like to thank all of our panelists today for joining us on the call and sharing their perspectives on the new guidance, and in particular, Carmen Hawley for taking time from the Federal Reserve Board to visit with us and have a discussion with me, Justin, and Melanie. So thank you once again. And this concludes today's webinar. We appreciate it, and we'll see you soon.
Thank you all.
Thank you.
Thank you.
Bye.
Bye.